Well, hello again, Solis Wealth family. Greg Solis here with the update. First of all, on the family front, we're in full summer mode for sure. We've been doing a little bit of traveling, which has been nice. Nicole has spent some time back in Hawaii. She's in summer school. Emily had the opportunity to actually go visit her while she was in Hawaii. So that's been fun to watch them spend some time together. And we just trying to keep cool here in the desert, going to the coast here and there. And so having a good summer so far. I hope you and your family are as well. Market-wise, well, last week was a little rougher week. After having a pretty good run-up, we've bounced back quite nicely since October of 2022. We've recovered a lot of what we lost in 2022 in the stock market, which was good to see. The S&P 500 right now is right about 8 to 9% off of its all-time high that it hit back in the early part of 2022, late 2021. That's the S&P 500 off still now about 8 to 9%. The NASDAQ still off about 15%. Remember though, the NASDAQ peak to trough was down about 35%. The S&P 500 was down about 25%. So we recovered quite a bit of it. And so that's good to see. Bond market has definitely stabilized quite a bit, which is good. We see yields on the 10-year treasury hanging right around 3.8%. But the challenge is we got the short end. Is the 30? If you look at the 90-day treasury, the 3-month treasury is right around. It's over 5% right now. So we still have that inverted yield curve. And the Fed came out last week and got a little more hawkish. We were expecting them, as we discussed last time. They hit pause. They didn't raise rates in June, but now there's conversation about them maybe raising rates in July, and they're talking about even maybe potentially raising them twice this year. The market didn't like that, and that's why we had a little sell-off this last week. And I think it was a good excuse for some profit taking. When you have that kind of a run-up that we've had since October of 2022, the market will look for reasons to take some profits. And so with the Fed getting a little more hawkish, saying that they might raise rates a little bit more, I think it gave the markets an opportunity to sell off a little bit. But overall, it's holding up pretty good. I think overall we're in good shape. I think the Fed probably will raise them maybe one more time, but I think it's a wait and see. Sometimes these interest rate hikes take a while to work through the economic system, and so we are seeing some slowdowns for sure. For example, we saw existing home sales in May down about 20%. That's a huge move, and that's going to have a ripple effect on the economy for sure. With mortgage rates going up the way they have, that's going to slow down the real estate market, and we're seeing other weaknesses out there as well. But so we see some strength still out there. So it's going to be a little tug and pull there for a little while, and so we got to keep a close eye on things. But perhaps we're going to see a Goldilocks, not too hot, not too cold, a nice soft landing here. So we're still anticipating a slowdown in the economy towards the end of this year, maybe into 2024. We might see some slowdown, perhaps a mild recession, but we think that it's going to be short-lived and the market will begin to price in the recovery. So that's it for now. Hang on tight. Overall, things look pretty good. We've got a nice bounce back, which is great to see. The portfolios are allocated nicely. Everything's positioned well. But if you have questions or anything else we could do for you, never hesitate to call. We're here for you. My very best to you and your family. Take care and God bless.